Introduction to investment styles. Investment styles are structured methodologies or philosophies that guide investors in selecting and managing their portfolios based on goals, risk tolerance, and time horizons. These styles have evolved over time, shaped by historical events and economic cycles. 1. Great Depression sparked value investing, as investors sought stability in undervalued companies with strong fundamentals. 2. Post-war economic boom encouraged growth investing due to rapid corporate expansion in sectors like technology and consumer goods. 3. Dot-com bubble highlighted the potential and risks of speculative growth investing, leading to a re-evaluation of valuation metrics. 4. 2008 financial crisis reinforced the importance of income investing, as investors sought reliable dividend-paying stocks for steady income amidst market volatility. 5. Modern era. Emerging trends like ESG, environmental, social, governance, and thematic investing reflect growing interest in sustainability and innovation. This chapter explores traditional investment styles, emerging trends, their advantages and challenges, and actionable strategies for implementation. 2. Value investing. Definition and characteristics. Value investing focuses on purchasing undervalued stocks based on metrics like price to earnings, PE ratio, price to book, PB ratio, and dividend yield. It emphasizes a long-term approach and intrinsic value assessment. Key metrics. 1. PE ratio. A lower PE ratio might suggest undervaluation, but should be compared to sector averages to avoid underlying issues. Example: for a stock priced at $100 with an EPS of $5, the PE ratio is P/E equals earnings per share EPS divided by price per share. For a stock priced at $100 with an EPS of $5, PE equals 100, divided by 5 equals 20. Thus, the PE ratio is 20. 1. PB ratio indicates undervaluation relative to book value, but requires assessment of asset quality. Example: if a company has a market price of $50 and a book value per share of $25, the PB ratio is. The PB ratio, price to book ratio, is calculated using the formula PB equals market price per share divided by book value per share. PB equals 50 divided by 25 equals 2. Thus, the PB ratio is 2. 3. Dividend yield. High dividend yields can be attractive for income, but may indicate financial distress if unsustainable. Example: if a company pays an annual dividend of $4 per share and its stock price is $100, the dividend yield is. Dividend yield equals dividend per share divided by stock price times 100 equals 4, divided by 100 times 100 equals 4%. Thus, the dividend yield is 4%. Case study: Berkshire Hathaway's investment in Coca-Cola. Warren Buffett's purchase of Coca-Cola shares in 1988 exemplifies value investing principles. Despite a market downturn following the 1987 crash, Buffett recognized Coca-Cola's intrinsic value and competitive advantage. His initial $1 billion investment for a 7% stake has grown significantly over decades, yielding substantial returns. 3. Growth investing. Definition and characteristics. Growth investing targets companies expected to grow faster than the market average. These companies often trade at high valuations due to their future potential. Key metrics. Earnings growth rate, central to identifying potential growth stocks. PEG ratio equals stock price divided by earnings to growth. A PEG ratio below 1 suggests undervaluation relative to growth potential. Example: if a company has a PE ratio of 20 and an earnings growth rate of 10%, the PEG ratio is PEG ratio equals 10 divided by 20 equals 2. Thus, the PEG ratio is 2. Case study: Tesla's early growth trajectory. Tesla's rise exemplifies growth investing. In its early years, Tesla focused on innovation in electric vehicles, EVs, capturing investor interest despite high valuations. The company's commitment to sustainable energy solutions and rapid technological advancements led to significant stock appreciation. 4. Income investing. Definition and characteristics. Income investing prioritizes generating steady cash flow through dividends or interest payments. This style appeals to conservative investors seeking stability. Key metrics. Dividend yield indicates the annual dividend payout as a percentage of the stock price. Payout ratio reflects the proportion of earnings paid out as dividends. Example: dividend aristocrats. Companies like Procter & Gamble or Johnson & Johnson, which have consistently increased dividends for decades, exemplify reliable income investments. V. Momentum investing. Definition and characteristics. Momentum investing capitalizes on trends by purchasing stocks with strong recent performance, betting that upward momentum will continue. Tools for momentum investors. Moving averages tracks average stock prices over time to identify trends. Relative Strength Index, RSI, measures the speed and change of price movements to identify overbought or oversold conditions. 5. Index investing. Definition and characteristics. Index investing is a passive strategy that tracks market indices, for example, S&P 500, through mutual funds or ETFs for broad exposure at low costs. Enhancement. Core satellite approach. Allocate most of the portfolio, 60 to 80%, to index funds for stability. Invest the remaining portion, 20 to 40%, in actively managed funds or individual stocks targeting high growth sectors or emerging trends. 7. Diversification. Diversification involves spreading investments across different asset classes, sectors, and investment styles to reduce risk and enhance portfolio resilience. Benefits. 1. Reduces exposure to any single investment's poor performance. 2. Balances risk across various economic conditions. Example: a diversified portfolio might include A. Large cap stocks for stability, B. Growth stocks for capital appreciation, C. Bonds for income generation, D. International equities for geographic diversification. 8. Risk management. Risk management aligns investment strategies with personal risk tolerance, while minimizing potential losses. Tools. 1. Diversification. Reduces concentration risk by spreading investments across asset classes. 2. Stop-loss orders. Automatically sell securities when prices fall below a predetermined level. 3. Asset allocation. Adjust portfolio weightings based on risk tolerance and market conditions. 9. Adapting to market cycles. Recognizing how economic environments affect investment styles can help investors optimize portfolios. 1. In bull markets, growth strategies excel during economic expansions, when investor confidence is high. 2. In bear markets, value strategies gain traction, as investors seek stability in undervalued companies with strong fundamentals. 3. In stable markets, income strategies provide consistent returns through dividends, when capital appreciation is limited. By aligning strategies with market cycles, investors can enhance performance while managing risk effectively. X emerging trends. ESG investing incorporates environmental, social, and governance factors into investment decisions. Thematic investing focuses on specific trends, like artificial intelligence, AI, clean energy, or cybersecurity. Conclusion. Recap of investment styles. Each style, value, growth, income, momentum, index, offers unique advantages suited to different investor goals. 1. Value investing appeals to patient investors seeking undervalued opportunities. 2. Growth investing suits those willing to take risks for higher potential returns in innovative sectors. 3. Income investing provides stability through consistent cash flow from dividends or interest payments. 4. Momentum investing capitalizes on short-term trends but requires active monitoring due to high volatility. 5. Index investing offers simplicity and diversification, but lacks flexibility during downturns, unless paired with active strategies, like core satellite portfolios. Actionable recommendations based on investor profiles. 1. For risk-averse investors, focus on income investing, with dividend aristocrats for steady cash flow. Consider index funds, like Vanguard S&P 500 ETF for broad diversification, with minimal risk. 2. For moderate risk takers, combine value stocks with stable fundamentals and growth stocks in innovative sectors like technology or biotech. Explore ESG funds for sustainable returns aligned with personal values. 3. For aggressive investors, prioritize growth stocks in disruptive industries such as AI or clean energy. Incorporate thematic ETFs targeting emerging trends, like cybersecurity or the metaverse. Use momentum strategies but set stop-loss orders to manage downside risk. By diversifying across styles, while adapting strategies based on market cycles and personal risk tolerance, investors can build resilient portfolios tailored to their financial objectives.